Hello, good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be the Thursday, the 17th of July, 2025. So as usual, before we jump straight into today's gist of the Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the intraday technical outlook of the $4 major pair that we cover on a daily basis, the 6 major US stock indices and the 2 key commodities, gold XAU/USD and West Texas crude oil. Let's have a quick recap what has taken shape yesterday and as well as in today's early Asia session before the start of our daily dose at 11 a.m. Singapore time in terms of news flow, economic data release, and their respective impact on the intraday movement of those broad-based cross-asset classes. So let us start with the movement of the major US stock indices yesterday. So if you look at the major US stock indices yesterday, it's quite volatile, I would say. So if you look at the SPX 500, initially it traded sideways from 9:30 p.m. Singapore time all the way up to around, let's say 11 p.m. Singapore time, pardon me, and suddenly there was actually a huge significant intraday sell-off from the 11 p.m. mark to the 11:30 p.m. mark yesterday before recovering, all right, and close at a session high by the time the US session closes yesterday. So very clearly also this is being seen on the Nasdaq 100 as well, and as well as the Dow Jones Industrial Average over here. So overall, the SPX managed to inch out a gain of 0.32%. The Nasdaq 100 managed to close near the key resistance level at 22,907, but underperformed by 0.10%. The Dow Jones and the Russell 2000 outperformed with a gain of 0.5%, and the Russell 2000 is up almost 1%. So one of the reasons what causes this erratic, we call it a sell-off, at the 11 p.m. to 11:30 p.m. mark yesterday was this particular news flow out from Trump. So this Trump versus Fed Chair Powell drama starts to actually erupted yesterday during the US session, where initially there was a report stating that Trump has spoken to his party, Republican lawmakers, to take a look at the current US Constitution, that means the US law, whether would there be any possibility of firing Powell based on certain reason. And we know that Trump has been criticizing Powell on the current Fed wait and see attitude or wait and see stance, reluctant to actually cut interest rate as wanted by the US White House administration, because Trump deemed that US interest rate, the Fed funds rate, which is at 4 to 4.25%, is still too high, and it should be reduced to close to 1.25%. So initially, then thereafter, okay, because previously there's this news was a White House official and some lawmakers said that they expect Trump to move against Powell after a meeting to discuss cryptocurrency legislation. But Trump's remarks left open the possibility of ousting Powell only for costs over here. Then thereafter, President Trump denied that he is seeking to remove the Federal Reserve Chairman Powell, saying that no, we are not planning on doing anything, but I don't rule out anything. But I think it is highly unlikely unless he has to leave for fraud over here. So it seems to us that Trump is trying to do a bit of test balloon over here in how the market will actually react if he were to suddenly fire Powell due to fraud. And we know one of the fraud that the White House administration is accusing Powell of finding fraud is the current renovation costs in the Federal Reserve office buildings kind of blown out of a budget over here. So White House officials are claiming that Powell actually lavishly burst the budget that is being allocated for the renovation of the US Federal Reserve Office building. So that causes that, that erratic movement in the major US stock indices yesterday. And also this movement is also being seen at the FX market as well. So at around the 10:40, what is it? 10:45 p.m. mark Singapore time, we also see a dramatic sell-off in the dollar across the board before the dollar starts to recover uh, as we are speaking right now. So if you look at this is the 5-day rolling performance as of now. So what I will do is let me share with you guys. So this will be as of 16. Right, as of 16th of July, 17th of July, pardon me. So this is a 5-day rolling performance. So like I say, at this mark in time, the 10:45 p.m. Singapore time yesterday, the dollar actually sold off against all the major currency before recovering much ground after US President Trump denied that he has currently no intention of firing Powell. And if you look at the 1-day rolling performance, as we are speaking right now, the dollar is strengthening very strongly against the Aussie dollar. So and also managed to actually drag up the Kiwi as well. So we know that the Kiwi and the Aussie dollar tend to have a very close co-relationship directly. So once we start to see either one of these pair move, the other pair will move as well. So the dollar is appreciating very significantly against the Aussie, and that dollar strength is being reflected against the Kiwi as well, and not so much against the dollar yen. Dollar yen tried to actually trade sideways after at the start of today's Asia session, and the rest of the other dollar major pair also starts to trade sideways as well. That means either the dollar CAD, the dollar against the sterling pound, the dollar against the euro, the dollar against the Swiss franc. And what's interesting over here is that the dollar against the Chinese yuan continues to be like a blip, one little horizontal line as the China central bank continues to actually rein in dollar strength. Okay, so what's the reason that causes the Aussie dollar to be the weakest, or what is the reason that causes the dollar to be the strongest against the Aussie dollar is due to a rather shocking soft labor data coming out from Australia early this morning before the start of our daily dose. So let's take a look at this data. So which is this one is called employment change. So employment change for the month of June over here, market is initially expecting a rather high number of 20k jobs added, but it only added less than 10 times less than the what the consensus is forecasting. So it came in at only 2k jobs added, which is a rather a soft number. And what's interesting over here is that the unemployment rate, after being held steady for around 4.1% almost entirely since the start of this year, suddenly it actually inch up higher to 4.3% by 2 basis point higher. So if you look at the unemployment rate, all right, so this is what I mean. So since the start of the year, okay, so let's go to the 5-year trend. Okay, so it has been hovering at this 4.1% since the start of this year. All right, so suddenly it just tick up higher to 4.3, and this tick up of the highs of 4.3 is the highest jobless rate since November 2021. So what it means that over here is that the labor market in Australia has started to turn very soft based on the June data, and that also solidified that the RBA got to act pretty soon, because still recall that the RBA in the previous meeting not too long ago, about 2 weeks back, they actually maintained interest rate stand pat going against market expectation, where they expect a cut. Then that actually supported the Aussie dollar to rally pretty strongly during last 2 weeks off, and they also outperform the other major currency in terms of against the dollar. But so far it can't break above this key intermediate resistance at 0.66, and today it tumbled below its 50-day moving average. So right now, potentially we may start to see some form of intraday weakness, at least for today, given that certain key technical short-term support level has been taken out to the downside, reinforced by this rather surprisingly soft, or I would say surprisingly significantly soft labor market data in Australia that may potentially force RBA to be much more dovish rather than be a much more kind of a hawkish kind of a whole attitude going forward. All right, so later I'll touch more on the short-term intraday technical outlook on the Aussie dollar. All right, so then let me share with you the heat map of the S&P 500. So we know the heat map of the S&P 500 yesterday. I would say that it was almost even number of green and red, more green than red over here. But we start to see certain, we call it profit taking in the mega cap technology stocks. All right, so Meta is down by almost 1%, 1.05%. Amazon down by negative 1.4%. Very lackluster gain in Apple, only up by 0.5%. Nvidia, after rallying to 2 consecutive days of more than 1% and hit fresh all-time high yesterday, only managed to inch out a minor gain of 0.4%. And Microsoft almost unchanged at negative 0.04%. So what causes the mega cap technology stock, especially those that are related in AI? Metal is related in AI. Microsoft as well, being also investing very heavily in what I call AI business-driven model. And definitely NVIDIA is the guy who provided the equipment to run this AI business initiative through their very specialized we call it higher end semiconductor accelerator chips. All right, it's only up marginally by 0.4%. Is due to the rather lackluster forward guidance given by ASML. So we know that ASML is not listed as a key component stock in the Nasdaq 100 or even the S&P 500 because it's still very important. It's actually the primary market of ASML is in the Holland stock market, which is Dutch. So this ASML is a very, very important semiconductor player within the global semiconductor chain. That means in order for NVIDIA chips to actually not always in order for the final assemble product that run the AI, whatever AI model, ASML is required in this grand jigsaw puzzle because they hold the so-called specialty in lithography, is the designing of those chips. Okay, to put in the story short, they have this so-called very, very unique we call it cutting edge ability. So far in the entire world, only them that are able to actually do this kind of very special form of design of this semiconductor chip to run those higher end we call it much more efficient accelerator chips in this ongoing AI driven so-called boom that we are seeing right now. So ASML, yes, their current Q2 earnings beat expectation, but they warn that macro environment is rather uncertain, and their 2026 earnings growth and sales revenue growth cools down over here. So what it means that ASML chief executive walked back his forecast that sales will grow next year, blaming trade dispute and global tension. That means it kind of reduced next year growth forecast of AML. All right, so ASML, pardon me, not AML, ASML. So that actually causes a bit of negative feedback loop into the Nasdaq 100 key component stocks, which is those mega cap technology stocks that skewed towards AI to actually perform rather a lackluster intraday performance yesterday. So that actually explains why the Nasdaq 100 is the underperformer. It's only managed to inch out a meager gain of 0.10% over here. All right. So other than that, let's have a quick look at the another data I want to share with you guys over here is the PPI data out from US. So PPI data is actually a tier 2 inflationary data. Tier 1 we definitely for sure is the CPI and the PCE data. So CPI data is out yesterday. So yesterday CPI data, if you go down to the individual category of the basket, which I shared with you yesterday, those baskets like toys, start and actually housing finishing starts to show signs of tariff-induced inflation. All right, but if you look at the core PPI data, which is considered as factory goods, factory gate prices, that means, i.e., what is the manufacturers in US paid for their raw materials, put in a way, in a very simple form, managed to actually rose below expectation. So the core PPI, stripping out energy and so-called food related raw materials, on a year-on-year basis, they only rose 2.6%, and it came down slightly below than 2.7%, and also below by 3.2% as well. And on a month-on-month basis, there is actually no growth at 0%, and also below market expecting of 0.2%. So that kind of cool down or reduce the fear of what we call it inflation situation in the US. All right, but still too early to say, given the fact that we know that Trump or the US White House administration way of erratic way of tariffs implementation, and also we have an array of tariffs to actually be mindful of. So overall, after the release of this news flow, yesterday news flow, and as well as that drama coming out from Trump versus Fed Chair Powell, let's take a look at the CME Fed Watch 2, where the market pricing of Fed funds futures traders has on the expectation of the future Federal Reserve monetary policy. So still very high chance that the Fed funds futures traders are expecting the Fed to remain on hold on the upcoming meeting, FOMC meeting on 30th of July, to be at 97.4% chance to maintain the rate at 4.25% to 4.5%. So let's look at the aggregated tab, where we start to see what is the expectation or the odds for the other meetings down the road towards the end of this year. So we start to see on the 17th of September, which is the next meeting, still rather lower. Yesterday was around 57%, but the day before means upon the release of that CPI data, it was at 57%. Yesterday, it inched up slightly higher, but still remains below 60% at 59%. So market participant is still not so very certain right now, based on the current data, whatever data that has been released, that they only start to assign a rather low odds of 59% that the Fed will potentially move and cut their first interest rate for 2025 in the 17th of September 2025 meeting. And what they are actually expecting is a rather high chance that they push the can down the road to ignite the potential first rate cut to be on the 29th of October. This is a rather high chance of 89%. Then also maintaining a high chance of 80% that the last cut for 2025 will come in during the 10th of December FOMC meeting. So that potentially brings down the Fed funds rate into the last meeting of 2025, which is the 10th of December 2025, to be at 3.75% to 4%. So that actually implied potentially two interest rate cut of 25 basis point each before 2025, and so still within that forecasted range, where the Federal Reserve officials also projected during the last dot plot in the June FOMC meeting over here. All right, so before I continue, let's just to make sure that everything is good. The voice and the screen can be heard. All right. Okay, sure. So where are we now? Okay, so I've covered much ground on the first segment of the daily dose. So let me touch a bit of the bank's earnings that was released yesterday. So bank's earnings released yesterday, we have US major banks, which is the Bank of America, Goldman Sachs, and Morgan Stanley. So Bank of America actually pull up very mixed result. So their net interest income misses analyst expectation. So that actually explain a lackluster movement on their share price yesterday. So the one that shone very brightly is Goldman Sachs over here. So Goldman Sachs top estimate, especially in their trading revenue, where their traders generate 8,400 million revenue more than expected, and that causes their share price to shoot up yesterday. And as well as Morgan Stanley over here. But Morgan Stanley, at the end of the day, despite their earnings beat, but their investment banking revenue strings over here. So overall, in a nutshell, I would say that out of these three major US banks earnings over here, we start to two of them are rather lackluster, new one shown. So if you look at the S&P heat map over here, what you could see is that Bank of America is down by negative 0.26%. we have Morgan Stanley down more than 1%, negative 1.27%, and the one that shone through yesterday is Goldman Sachs, up by 0.9% over here. So net overall, that this throw of we call it major US banks did manage to actually trigger off a significant rally in the S&P 500 and especially in the Dow Jones Industrial Average. Still not able to capture yesterday's intraday loss. Prior day intraday loss, pardon me, they're only up by 0.5%, given that the Dow Jones Industrial Average has a more significant weightage in the US financial sector versus the S&P and the Nasdaq 100. Later, I'll touch on more on the intraday technical outlook on the US Wall Street 30, which represent the Dow Jones Industrial Average. All right, so without further ado, that sum up the first segment of today's daily dose. Now, let us now move on to the second segment over here, which is the intraday technical outlook segment. All right, so let me so-called widen my screen. Okay, good. Yeah, the screen is widened. So let's start with the FX market over here. Okay, starting with the euro dollar. So yesterday, the euro dollar, we went into a neutrality stance over here because price action is at the point in time is trading close to a inflection zone or level, which is the medium term ascending channel from 13th of May 2025 low. All right, so yesterday price action challenged this lower boundary of this channel before staging a bounce, and this bounce can't clear above the upper limit of the neutrality range that we have yesterday. So yesterday we flipped to a neutrality stance with the upper neutrality limit at 116.60 and the lower neutrality limit at 115.80. So it actually trade within this neutrality zone. Yes, a bit of whipsaw where yesterday we start to see a spike up, but this spike up don't have a daily close above 160.60, and this spike up is actually caused by that Powell threat of firing. We call it a Fed chair, not a Trump threat of firing Fed chair Powell. All right. So what's interesting over here is that yesterday it printed a lower low, all right, before reintegrating back above the medium-term ascending channel lower boundary or support level. Upon printing this lower low, the RSI hit a oversold level again and starts to print out a bullish divergence. All right, so that's a bullish divergence right now, indicating that yesterday's movement has started to lose their respective downside momentum. So with this positive element that is being fleshed out by the hourly RSI for today, I'll flip to a bullish buyer stance using 115.80/150.60, which is yesterday's minor swing low, as my short-term pivotal support zone. Potentially there could be some signs of recovery coming today. So two resistance level to watch will be at 160.60, followed by 117.10 on the intraday basis, which was tested yesterday as well. A clear break above 117.10, that means an hourly close above it, will potentially increase the odds of a fresh impulsive up move sequence, because by clearing above 117.10, it also cleared above the current this minor descending trend line that is managed to cap prior rebound since the minor high of 3rd of July. So yesterday it also got rejected upon testing this minor descending trend line as well. So to actually kind of eradicate the bearish, any residual bearish forces, it got to have a clear breakout above 117.10, which is an hourly close above it. Then from there, we could increase the odds of a start of a potential fresh impulsive up move sequence in first step towards 117.70, followed by 118.10 and 118.25. However, a price action did manage to go in our expectation and starts to plunges down again and break below 115.60, then this minor corrective decline sequence will continue to extend towards the downside, exposing the next intermediate support zone at 115.10/114.90, which confluence with the rising 50-day moving average. All right, so that's for the euro dollar. Next up will be the sterling dollar. So sterling dollar, yesterday we do have a bearish bias. Price action can't break above the former medium-term ascending channel support, now turns into a pullback resistance, which is dotted bright pink line over here. Yesterday intraday movement tested this, can't break and break and starts to move downwards. So this 134.30 was yesterday's short-term pivotal resistance level that we have. So it hit our first support at 133.75 before stepping that bounce. Okay, so what we could see over here is that it also starts to flash out a bullish divergence. Right, there's a bullish divergence that's being seen. So with this bullish divergence that is being flashed out on the sterling dollar, for today, my conviction to maintain my bearish bias that I have for yesterday has been reduced. So instead, I will have a neutrality stance instead. So neutral between 134.30 and 133.75. Only a breakdown with an hourly close below 133.75 will reinstate my bearish bias view on the sterling dollar to expose the next near-term support at 133.25. Below 133.25, which is the former minor swing high of 16th of May, below 133.25 exposes 132.50 next, which is the minor swing low of 15th of May and 16th of May. Right, so that's for the sterling dollar. Flipping to a neutrality stance for now, neutral between 134.30 and 133.75. Okay, up next will be the Aussie dollar. So what I could see over here is that the Aussie dollar has kind of broken down below the 50-day moving average over here, which is at 64.80, 64.85 over this level here. And yesterday we were neutral. We flipped to a neutral distance. So given this bearish breakdown of 64.85, potentially on the intraday basis, there could be still some form of residual weakness. So switching to a intraday bearish bias view for a potential extension of this potential residual weakness movement on the Aussie dollar, using 65.10 as my short-term pivotal resistance level. Next support level to watch will be at 64.45, which is if you do the Fibo retracement, taking into account of this last push up towards the 66 psychological level that it can't break. So that actually constitute to the golden ratio of 61.8% as well, and this minor congestion area of 19th of June and 23rd of June at 6445. So a breakdown below 6445 potentially sees the 76.4 Fibo retracement, which is so this minor congestion area of 23rd of June and 24th of June, and confluence very closely with the 200-day moving average at 64.20. So the 200-day moving average is slightly lower at the 64 figure level. All right, so I'm watching 65.10 short-term pivotal resistance level, flip to an intraday bearish bias for this residual push down on the Aussie dollar. Support level to watch, firstly 64.45, breakdown below it exposes 64.20. So once coming towards this zone over here, I'll be looking out for bullish reversal candlestick to flip back to a bullish bias again. So however, if price action instead of coming downwards and starts to do a dramatic U-turn over here, that means this is a failure bearish breakdown below the 50-day moving average and starts to reintegrate back with an hourly close above 65.10. Then today's intraday bearish bias view for the residual push down will be invalidated to potentially see a revival of at least some form of recovery to retest 65.40 followed by 65.75 in the first step over here. So that's for the Aussie dollar. Okay, next up will be the dollar yen over here. So what I could see over here is that if you look at the daily chart of the dollar yen, so dollar yen has already starts to come very close to the 200-day moving average and the pivotal resistance of 149 over here, which is the kind of the range stop that has been in place since this range configuration started on the 22nd of April low. All right, 22nd of April low. So if you were to look at the current dollar yen chart on a short-term basis, the hourly time frame chart over here. So price action yesterday got rejected at the 149 level. It traded back down again and now attempting to actually push up towards this 149 level, all right, as well. So given that it's coming very close to this key resistance level 149, 149.60, so I will not be so adventurous to actually play this push up because it's just very little at this point in time. So given the fact that let's take a look at the RSI. So the RSI, there's no signs of a so-called bearish divergence or any exhaustion sign as well. So with that, I'll rather flip to a neutrality stance again for today, unless we start to see some form of bearish divergence upon hitting the overbought level over here during the European session. So for now, given that it has not seen anything, so I will have a neutral bias over here. So lower limit will be the 14770, which is now also the minor ascending channel support taken from the low of 1st of July. Okay, so flipping to a neutrality stance again for today, using 14960 as my upper limit, which is the 200-day moving average, and so as the top of this ongoing minor ascending channel. Lower limit will be yesterday's minor swing low area, which is close to the confluence with the lower limit, with the lower boundary of this minor ascending channel as well, at 14770. So flipping to a neutrality stance on the dollar yen between 14960 and 14770. 14770 for today. All right, so that's cover the intraday technical outlook on the FX market. So now let's focus on the major stock indices, starting with the Hong Kong 33, which is representing the Hang Seng Index over here. So the Hong Kong 33 continues to actually hover around the pivotal support that we highlighted at 24,390. Yesterday, it managed to do a bounce during the US session, and in today's Asia session, there's a pullback. Okay, but still holding above the 24,390. So still no change. Still watching the 24,390 as my key pivotal short-term support for the Hong Kong 33 for today, to maintain a intraday bullish bias view. First resistance level to watch for today will be a lower level, which is today's intraday high over here, that is being made during the start of the Hong Kong stock market session at 24,650. Okay, let me put it in writing. 24,000. Oops. Okay, hopefully the things gets. Okay, usually it hang for a while. Oh, it still hang. I don't know why. Okay, let me try again. Okay, good. 24,650. Okay, put it in red. Okay, so above 24,650, potentially see a revisit on Wednesday's Asia session high that was tested before that pullback take shape, which is also the medium-term swing high of 18th of March and 19th of March 2025 medium-term swing high area at 24,850. However, if price action starts to break down below 23,390, then today's intraday bullish bias will be negated to see a minor corrective decline to retest 24,050, which is the rising 20-day moving average. And I'll be on the lookout for bullish candlestick reversal pattern around the 24,050 level to flip back to a bullish bias stance again, given that it's still in a medium-term uptrend phase for the Hong Kong 33. All right, so that's the Hong Kong 33. Next up will be the Nikkei 225, which is the Japan 225. All right, so the Japan 225 continues to trade within this minor bullish descending wedge configuration. All right, so yesterday it tested the upper limit of the descending wedge before trading downwards, but managed to actually survive at the 200-day moving average. And also yesterday during US session, it also tests the pivotal support that we highlighted, but managed to stage a bounce. And where it bounced, right, also bounced off from this descending trend line over here, which is the ascending trend line, not descending, ascending trend line from the low of 23rd of May. Right, so that is a rather positive development that has taken shape yesterday, given that it kind of reintegrate above the 20-day moving average and shape a bullish dragonfly hourly doji candlestick upon the retest of the medium-term trend line support level drawn from the May low earlier that I highlighted, which is also our pivotal support that we highlighted yesterday at 39,145. So for sure, this is indeed a key level at 39,145 that managed to attract bullish forces to creep back into the market yesterday. So we will still maintain our intraday bullish bias given yesterday positive development right at the pivotal support level. at 39,145 based on the price action that I explained earlier. So 39,145 will still be my pivotal support, still maintain that intraday bullish buyer's view, but upside trigger level slightly adjusted towards yesterday's Asia session high at 39,845, which is also the upper limit of this ongoing bullish minor descending wedge configuration. This is 39,845. Okay, so a breakout above 39,845 potentially sees the minor swing high of 8th of July in first step at 40,040, followed by the minor congestion area of 30th of June at 40,355 in the first instance. However, a price action suddenly did a U-turn again and staged a bearish breakdown with an hourly close below 39,145. Today's intraday bullish bias will be invalidated to see a choppy minor corrective decline to retest the former range resistance. Now turns into a pullback support from May 2025 at 38,850. A breakdown below it sees a deeper minor corrective decline sequence, revisiting the 50-day moving average, confluencing at the next minor graphical support at 38,450. All right, so that's for the Nikkei Japan 225 over here. Next up will be the Germany 30 representing the German DAX. So the German 30 German DAX continues to actually trade above the pivotal support that we highlighted, 23,950, and also above the 20 and the 50-day moving average as well. That is confluencing very closely with 23,000. Okay, what is this? This was the previous one. Okay. Okay, so for the Germany 30, still no change, still looking to maintain a bullish buyer stance for today using 23,950 as my short-term pivotal support level. Price action yesterday indeed test the first trigger level, upside trigger level, come breakout at 24,180. So this will be my first resistance level to watch again as the European session kickstart in a couple of hours time. A breakout above 24,180 will give prudence for the start of a fresh impulsive up move sequence. Looking out for the next intermediate resistance to come in at 24,320, followed by 24,520 next. However, a price action starts to break down below 23,950. Today's intraday bullish buyer's view will be invalidated to see the extension of the minor corrective decline and also potentially the invalidation of this medium-term uptrend phase, given that it also have broken down below the 50-day moving average to expose the next support level to watch. In first step will be at 23,815, followed by 23,640, which is the minor swing low of 1st of July and 2nd of July over here. So that's for the Germany 30. All right, up next will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 yesterday tested our first support zone, which is 43,800 / 43,600 during that drama between Trump and Fed Chair Powell, potentially sacking, all right, by Trump. So price action managed to actually pierce up but stalled above the 44,310 short-term pivotal resistance level that we highlighted. So let me remove this. All right, so still no change. This level is indeed a resistance level, 44,310. Okay, so still using 44,310 as my short-term pivotal resistance level, still maintain a intraday because the hourly RSI still continues to shape a lower high over here. All right, so still maintain our intraday bearish buyer's view. First support level to watch will be the support level that we highlighted yesterday at 43,800 / 600. So only a breakdown below 43,600 potentially sees a deeper corrective pullback towards the next support level at 43,290 / 43,160 within its still ongoing medium-term uptrend phase. All right, so whatever weakness that we see on the US Wall Street 30 potentially that may unfold is more of a minor corrective decline sequence within a medium-term uptrend phase that is still intact for the US Wall Street 30. So that's pretty much similar on the SPX 500 as well over here. So for the SPX 500, still maintain that bearish bias view after the price action. Yes, price action tested our first support level 6,220, but can't have a hourly close below it and starts to bounce over here. The hourly RSI continues to shape a lower high, okay, indicating the lack of upside momentum. So with that, we still maintain our bearish bias view for today using 6,290 as my short-term pivotal resistance level. First support level to watch will be 6,220. Only a breakdown below 6,220 exposes 6,180 next, which is the 20-day moving average, right? Below it sees a deeper minor corrective pullback towards 6,136. That's for the SPX 500. All right, next up will be the NASDAQ 100 over here. So the NASDAQ 100 also managed to shape a bounce, all right, towards our pivotal resistance level. And also the hourly RSI also has this lower high as well, all right? Okay, so with this lack of bullish momentum as represented by the RSI. So I will still maintain that intraday bearish bias view for the NASDAQ 100 using 22,920/23,020 as my short-term pivotal resistance zone over here. First support level to watch will be 22,600, which confluence with the rising 20-day moving average. Breakdown below it exposes 22,390/22,390, pardon me, /22,235, which correspond to the medium-term ascending trend line from the low of 23rd of May. However, if price action did a U-turn above 23,020, today's intraday bearish bias view will be invalidated to see a squeeze up or the start of an impulsive up move sequence towards the next resistance level, which is a fresh all-time high at 23,190, followed by 23,400/23,480, defined by Fibonacci extension cluster levels. Okay, so that sum up the intraday technical outlook on all the 6 major stock indices. So now let us now focus our attention to the commodities asset classes, starting with the gold XAU/USD. So gold XAU/USD continues to trade between our pivotal support level and as well as the first resistance level that we highlighted yesterday, the 3,360/3,374. So price action now also trying to do a pullback towards the support level. So upon pulling back towards the pivotal support level, we start to see a bullish reversal candlestick that's being formed. We start to see a sign of what I call it doji, not say doji, a bullish hammer formation. Okay, a small candle with a long tail at the bottom. And right now we are seeing a dragonfly doji potentially because the hourly is an hourly candle. The hour hasn't ended yet. And also where it formed right exactly at the 20-day moving average, and also the medium-term trend line support from the low of 31st of December 2024 low. And so therefore no change, still watching the 3,328 because now it's coming very close to this pivotal support again. Still maintain that bullish bias view within this minor sideways range configuration that has started to form since the start of this week, which is 14th of July on Monday. So only a clearance above 3,375 potentially kind of kickstart a impulsive up move sequence on a minor time frame or intraday time frame towards the next intermediate resistance at 3,400, followed by 3,450. So, however, if price action starts to break down below 3,328 with an hourly close below it, then today's intraday price movement on gold, the bullish bias will be invalidated to see a choppy corrective decline to revisit the 9th of July 2025 minus swing low, which confluence with the next intermediate support zone at 3,293, followed by 3,282 next. So that's for gold XAU/USD. Next up will be the West Texas crude oil over here. So the West Texas crude oil, what we could see is that it continues to plunge lower, and right now it already hit our support zone, the support zone that we highlighted yesterday at 6,010, 6,000, okay, this 6,010, 6,000, 6,610, 65.20. A bit of tongue twisting. 66.10, 65.20 over here. And the RSI now tries to actually exit from the oversold level. So what it appears to me over here right now is that it starts to trade back up. Okay, still in a range. So this is a range, minor range configuration since the low of 25th of June. All right. So since it hit the almost hit the lower the support zone, which is the lower limit of this minor sideways range configuration, 66.10, 65.20. So I'll be using 65.20 over here as my pivotal support level. Okay, short-term pivotal support level. All right, so for today, we will turn into a bullish bias, but we're in a range configuration for it to float up towards the top of the range at 69.15. Right, 69.15 next over here. So, okay, I have a first resistance, which is the 20-day moving average at 67.80. Okay, 67.90. Okay, so first resistance 67.90. Above it sees the upper limit of this sideways range configuration to come in at 69.15 next. All right, so for today we will flip to a bullish bias since that price action already hit the range support level and starts to bounce off, and also bounce off the 50-day moving average. So right now there could be a chance using 65.20 short-term pivotal support for it to bounce back towards the upper limit of the range again. Two resistance level to watch on the intraday basis, 67.90. A breakout above it sees the upper limit of the range coming in at 69.15. However, if price action starts to break down instead of going up at 65.20, with an hourly close below it, then I would invalidate today's intraday bullish bias to actually now see a bearish breakdown of this range for a impulsive down move sequence to unfold in first step towards the next support level at 62.75, which is the minor swing low area of 2nd of June and 5th of June. All right, so that's also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So today will be Thursday. So during the European session, we have another key UK data to take note of will be the job labor market data out from UK, the unemployment rate, and as well as the employment change. So for the unemployment rate, market is expecting to be stable at 4.6%. For the unemployment change, that's out at 2 p.m. UK employment change, not unemployment, employment change. Pardon me, bad tongue twisting. Market is expecting a softer number of job added, not that soft, 46K jobs added versus 89K job added in the previous month of April. And finally, down to the US session, we have the all-important retail sales figure because that's constitute labor services sector as well. And we know that the services sector contribute to 3/4 of annualized GDP growth in the US. All right, so that's 8:30 p.m. Singapore time retail sales. All right, so going forward, over here, what we have another Federal Reserve official speaking at 10 p.m. Singapore time, Fed Kugler, and that would be a rather quiet US session. And what we have at 1:30 a.m. Another official speaking, Fed Cook over here, followed by Fed Wheeler at 6:30 a.m. So before tomorrow Asia session start way early in the morning, we have Japanese inflation rate, which is very important for the dollar yen and the Nikkei 225 and the yen crosses. So that will be very early, 7:30 a.m. So market participant will be looking at the core inflation rate and the core inflation rate over here. So for the core inflation rate that exclude both fresh food and energy, the forecast is at 3.4% as done by Trading Economics. So that is continued to be a rather firm inflationary trend in Japan, 1 basis point above 3.3%. So if the inflation rate turns out much more hotter than expected, so that could potentially see some kind of downside pressure on the dollar yen, given that the dollar yen has really hit come very close to a pivotal resistance zone medium term at 49 figure 49.60, which I highlighted earlier. All right, so that sum up today's daily dose of market insights. I'm Kelvin here, and just a heads up, tomorrow I will not be around, so tomorrow there'll be no daily dose for tomorrow, and daily dose will resume again on next Monday, 21st of July. All right, so with that, have a great day ahead, and we shall speak again soon. Thank you.